All right, we will, as I mentioned, thank you everyone for joining us today. My name is Dan Reed with Score Maine. We'll be presenting and talking a little bit about business credit today. We're going to give it a few minutes to see if we can work out some issues with voice, as well as give it a few minutes for folks to join. Hopefully, we're not having any Zoom issues today. And then we will hopefully get started shortly. In the meantime, please feel free to tell us a little bit about your business or a little bit about yourself in the chat and what you're hoping to learn today about business credit so we can make sure that we're addressing your concerns.
Hey, Dan,
There we go.
you can hear me.
Yes,
Oh,
perfect.
that took a little bit of work and
I'm glad we got there. Hopefully, we're not having other Zoom complications today. I see some duplicate logins, and I definitely feel as though we have more people signed up than we have here today. So maybe we're having some Zoom complications. But in the interest of the time of the folks who have joined us, I feel like we should go ahead and get started. So I want to say thank you to everyone for joining me today. As I mentioned earlier, my name is Dan Reed. I'm with SCORE Maine. And if you're unfamiliar with SCORE, we are a SBA resource partner where we provide one-on-one small business mentoring and we provide workshops from experts in the field, just like this one, where we ask folks to come and talk to us about topics that are relevant to small businesses. And we have some folks here to talk to us about business credit today. We have Ethan and Jeanette from Saco Biddeford Savings. And I also wanted to say thank you to them as they are a fiscal sponsor of SCORE, who is one of the reasons why we can put on these these webinars for free is the support of local organizations like theirs. So thank you very much for that. And also thank you for coming to talk to us about this topic today. With that, I'll hand it on over to you and we can get the slide deck loaded up. If you have any questions at any time, please feel free to put them in the chat or use the raised hand function, and we will also have Q&A at the end of the session today. So, this is interactive. Feel free to jump in.
okay. Good afternoon. Thank you everyone for joining today. I'm Jeanette Garvillis from Saco and Biddeford Savings. I'm Vice President, Business Loan Officer. I've been in banking almost 30 years, and I've done about 15 years of the commercial and business banking side of things. So I have some experience, and um, I have retail experience as well. So I kind of had both sides of the coin. And I am happy to be here today to present why business credit is important. And I'll hand it over to Ethan, my colleague here at the bank, who has a great radio voice.
Wonderful. Thank you, Jeanette. You're too kind. Can everyone see the presentation and see the screen all right? Fantastic. All right, so we are going to jump right into it. As Jeanette said, welcome and thank you for joining us on this workshop of why business credit is important. So we're going to start by going over our agenda items today. We're going to take a look at the foundational differences between personal and business credit. We're going to dive into the factors that actually impact your scores. We're going to go over some actionable steps that you can take to grow your profile. And we are going to finish up with a few real life scenarios so you can get a better feel for how this all plays out when it comes to underwriting. So first off, let's look at what credit actually is. So at its core, credit is simply a measurement of your financial responsibility and your historical track record of paying back your debts. For business owners, having a strong track record is the foundation for your ability to grow, manage cash flow, and build your trust within the market. Now, there are two main types of credit. The first type of credit is personal. This evaluates you as an individual and it's tied to your social security number. It measures your personal financial responsibility, things like your mortgage, auto loans, personal credit cards. These FICO scores typically range from anywhere from 300 up to 850, and they are heavily protected by privacy laws. The calculation for personal credit is done using a fairly rigid mathematical formula. As you can see, the heaviest weights are on payment history at 35%, followed closely by your carried balances and your utilization at 30. This also factors in the length of your credit into the equation, as well as your mix of accounts and recent inquiries. On the other hand, business credit evaluates the financial health of your company and is tied directly to your business via its EIN, your employer identification number. It measures your track record of paying vendors and suppliers, and unlike personal credit, business credit scores often use a 1 to 100 scale, like the Dun Bradstreet Paydex score. And important thing about these reports is that they are public. Anyone can pay a fee to pull your business credit profile. So when we look at how business credit is calculated, it's very different from the personal side. Unlike that rigid formula, it's really more of a big picture assessment. Lenders interpret a complex range of data points, so those could be trade references, public filings, and cash flow, and using their professional judgment. It allows for more of a nuanced approach, meaning that underwriters are really looking to understand your complete financial narrative, and they're not just judging you by that single number. So the bottom line to all of this is, why does it matter? Well, strong business credit is really the deciding factor in accessing capital. It helps you secure lower interest rates. It unlocks favorable supplier terms like net 30, protects your personal wealth by eliminating your need for personal guarantees, and it gives you a strong negotiating power for leases and B2B contracts. So we have a pop quiz here. True or false, a small business owner as a small business owner, my personal credit score has no impact on my business's ability to get a loan because the business is its own legal entity. So what do people think about that? You can, feel free to pop that in the chat. Seeing false. And false is the correct answer. So commercial lending for small businesses is rarely non-recourse. So lenders almost always require a personal guarantee from any owner with 20% or more stake. This legally binding agreement means that your personal financial health secures the business's ability to borrow, allowing lenders to bypass some of the limited liability protections if the business happens to default. So let's talk about some specific actions that impact your business credit. Firstly, paying early. So unlike personal credit where on time is perfect, business scores like the Paydex actually require you to pay before the due date in order to achieve that perfect score. You also actively need to establish trade lines with vendors who report to commercial bureaus. And finally, you must protect your public records. Things like tax liens and the UCC filings, they will instantly tank a commercial profile. Cash flow is another critical component when it comes to your credit score. In personal credit, lenders are looking at your debt to income ratio, DTI, whereas in business credit, lenders are using debt service coverage ratio, which is the DSCR. This compares the business's cash flow to its debt obligations. So because small business loans require personal guarantees, commercial lenders will often look for your global cash flow. So this means your personal and business debts are combined to ensure that you can comfortably manage both at the same time. So let's talk about balances carried and utilization. Just like personal credit, you want to keep your balance to limit ratio below 30%. Remember, if you personally guarantee a business credit card, its utilization can directly impact your personal credit profile. This chart shows an example of keeping the utilization, overall utilization, at exactly 30% across multiple cards. So looking at this chart, while we have an overall ratio of 30, some of the individual cards, as you can see, are up at 40 and 50% and 0. So another kind of quiz question here for you. How could we distribute this debt so that the usage of each individual card sits at 30%? So a little bit of math required here. All right, so one way that we could balance this out would be to carry 10% from the Visa and 20% from the MasterCard over to the Discover. This would balance out each account at exactly 30%, which would be the optimal limit. Next is your length of credit history. So lenders evaluate the average age of all your open accounts. So opening a bunch of new accounts at once will drop that average. More importantly, in this regard, don't close your old accounts. Closing an old account will shorten your credit history and it reduces your total available credit. This causes your utilization to spike. So keeping those old accounts open and using them occasionally for small expenses does generate current positive payment data, which will really help when it comes to that length of history. Next up, ideal credit mixes. So having an ideal credit mix shows that you can handle various types of debt responsibly. For businesses, this typically includes revolving lines of credit, day-to-day cash flow, term loans for major one-time investments like equipment, and trade credit from suppliers, which acts as an interest-free short-term loan to help you sell your products before the bill is due. So making sure that you have that healthy mix kind of targeted broadly across three is very important. Next thing we'd like to talk about are the impact of inquiries. So when you're applying for these multiple different types of credit, you need to be mindful of your inquiries. A hard inquiry occurs when a lender pulls your credit, and a high number of those hits in a short period of time signals to lenders that you might be in financial distress with this kind of loan-seeking behavior. So you want to make sure that you're applying strategically, only when you really have to, and that you're preparing for a complete package for the underwriting of that loan rather than kind of shopping around. So here are a few steps that you can take to help your business credit grow here. You want to ensure that your business entity information is consistent across all records. You want to build your trade credit by opening Net30 vendor accounts. You should be monitoring your business credit health regularly using tools like NAV. And you always want to maintain that low utilization rate. So now we're going to dive into a few real life scenarios here. And I believe I'm going to turn that over to Jeanette, and she will kind of walk you through how this plays out when it comes to underwriting and loan approval in the real world.
Thanks, Ethan. So I'll just read these slides and then we can certainly chat about them. This is Sarah's Bakery, and the business age, the entity's been incepted, it's been about 3 years. It's an LLC, and the borrower is looking for a $50,000 term loan for some new commercial ovens. And personal credit is 630, so her FICO score is on the lower side of things. She has a high personal debt credit card utilization of 85% because she funded her business, her early business days using the personal credit cards. Her debt to income ratio is 48%, which is on the higher side of things, higher than banks like to see. The business credit, the employer identification number, which drives it. The PAYDEX score is 75. She has 2 trade references and pays exactly on the due date. Public records are clear. Recent activity that she's had on her personal credit are 5 hard inquiries in the last 4 months from shopping around for this equipment loan. And the business cash flow is highly profitable with a business debt service coverage ratio of 1.25. So, and I see your question, and I will get to that in just a moment. But in this scenario, would you lend to this particular borrower? And if you want to just type some answers in the chat box, and then we can discuss it. Okay. So in this case, and again, Whit, I will go back to your question. In this particular scenario, this is kind of a tricky one because when we're looking at a commercial loan, we look at multiple different areas. We look at obviously the business cash flow, how much debt the business has, if there's any. We look at the FICO score of Sarah, in this case, of the personal guarantor. So in this case, whereas the business cash flows and she can prove that she funded her early business days with using personal credit cards, which has driven her credit score down, along with the fact that she had 5 hard inquiries in the past 4 months. This is something where it would probably be a very gray area as if to we would lend. If she could explain the hard inquiries along with us paying down the credit card debt, possibly with increasing that term loan, we could certainly possibly look to lend to her, because the debt service coverage is good on the business part. It's just the FICO score would have to be mitigated with probably a written letter by her. We do that sometimes. We will allow that if she can explain it. Are there any questions on that? Because commercial lending is kind of more, it's a lot more gray than residential. We don't have to check off, we're not trading, we're not selling our loans on the secondary market, so we have a little more latitude when it comes to making some exceptions or having a policy exception. But in this case, I probably would advocate for her and advise her not to take out don't apply for any other loans, and to work on getting those credit cards down. So Whit, you had asked, what should a business do when their credit card issuer notifies them they are reducing the credit limit due to low utilization? And then from what was just said, that would hurt my credit rating. You could, in that case, that's a great question. You could certainly call the credit card provider, chat with them about it. And then another way to also mitigate that, you could start using the credit card and then just pay it off every month. And that could certainly work to get the credit utilization back up. But I always tell folks, call the credit card company first, because you certainly didn't ask to have it reduced. And again, you could put your groceries on it each week, or gas, or utilities, and then just pay it off each month. And from what was just said about hurt your credit rating, I don't believe it would necessarily hurt the credit rating. But I would, in this case, I would certainly just use the credit card and call the credit card company. So the card was being used, but the max balance never rose to a level they felt justified the old limit. Well, in that case, that is something with the credit card company itself. That would have to be something that you would have to work out with them, because, or you could do a one-time purchase, maybe buy an appliance or something to bring that back up and then pay it off the next month. But as far as the credit card company having their policies about that, you would have to talk to them. You're welcome. So we'll go on to scenario number 2, and this is Mike's Plumbing Contracting. The business age and the entity type is an S Corp. He's been in business for approximately 5 years. He is requesting a line of credit, a $100,000 line of credit to float payroll while he's waiting on large commercial invoices. His personal credit is 810, which is fantastic because FICO is max is, I believe, 850. So 810 is excellent. He hates debt. He pays his personal credit cards off in full every week, and his personal debt to income is only 15%. So all that being said, that's all good stuff. His business credit is, there's no score available. He has 0 reporting trade lines because he proudly pays all of his suppliers immediately with a debit card. He has never had a business credit card or loan. Public records are clear. Recent activity, there's no new accounts or inquiries in the past 5 years. And the business cash flow is highly erratic. Great annual revenue, but his month-to-month cash flow is tight, resulting in a debt service coverage of just 1.05. So in this case, would you, if you were the lender, would you lend to Mike's plumbing contracting business? And you can just drop your answers in the chat box. Okay. WIT has proposed receivables factoring, not an outright loan. That's not a bad idea. That's sometimes what we have to take as the collateral for the loan. And that is because accounts receivables are part of the UCC filing, when we put a UCC filing on a business for a line of credit when we're taking all business assets. So yes, we can use that to leverage the line. And the advice I would give him, this is something we could definitely look at lending to him, because given his debt to income, because we look at debt service coverage, we'll look at it as the business itself, which right here, that 1.05 is just the business debt service. It's not taking into account his personal credit in regards to his personal cash flow. So in this case, we could definitely look to approve the loan, because probably globally, taking his personal credit along with the business, we could do a global cash flow, and it would most likely be above the 1.20, given the scenario that is here. My advice to Mike would be, as far as the business credit, having zero reporting trade lines actually can be a negative, even though that sounds crazy, but it can be a kind of an adverse effect on the business to build that credit score up. And I would advise him to just pay on the 29th day or the 30th day, sometimes, on his revolving, or his suppliers and vendors. Besides that, no new accounts in the past 5 years. That's a positive. And again, I would, as the lender, I would definitely advocate to get this one approved, just basing on the global debt service. So taking his personal and the business together. Real life scenario number 3, Apex Tech Solutions. It's an LLC. It's been in business for approximately 7 years. The loan request is $250,000 for a commercial real estate mortgage to buy their office building. So currently they are leasing. Personal credit, $750,000, and the debt to income is comfortable at 30%. The business credit with Paydex score is 95. They have 5 strong trade lines and pay vendors 10 days early. They have an excellent credit mix, which, as Ethan had spoke about early, is always a good thing, to have a mix of lines of credit, term loans, and the vendor loan, or the vendor utilization for the Paydex score. He previously paid a term loan in full and a revolving line of credit and kept it at 10% utilization, which is fantastic. The public records, there's a state tax lien that was filed 8 months ago due to a dispute over payroll taxes with a former bookkeeper. It is unpaid while under dispute. Recent activity, 1 hard inquiry, and the business cash flow is very strong. Global cash flow combined, business and personal, easily supports the new mortgage. In this case, if you were the lender, would you lend to Apex Tech Solutions? I agree, Fred. I would certainly look to lend to him. The public records, the tax lien can certainly be cleared up prior to closing, or we could put a note in the file. We could do a credit memo stating that there's a dispute that's out there, and that this will be cleaned up once the dispute is taken care of. So there's always some latitude in situations like this if there's a tax lien and sounds like it wasn't necessarily his fault or the business owner's fault. It sounds like it was the bookkeeper who perhaps had made some errors with the payroll taxes. The potential tax liability. It's a great question. That is honestly, Whit, that is something that the tax liability is that would be a CPA question.
I was just thinking, if it's a small number, it's no big deal, but if it's significant, then it's a concern. The flip side is, if it was a bookkeeping error, they should be paying the payroll tax liability. Who cares if it's still under dispute? And if it wasn't a bookkeeping error, then maybe it was fraud or something else. They have an issue
Right.
with the bookkeeper more
Yeah.
so than with the taxing authorities.
Yeah, that is true. I mean, we'd have to obviously get the full picture and get what the tax lien is and how much, and then we could go from there. I mean, we look to work with folks, you know, and if it was something like you just said, what you mentioned, as far as if they were supposed to be paying taxes and they didn't, that would definitely be a discussion that would have to be had before we close the loan. We could approve it, and then certainly just basically, you know, a condition to close, pre-closing condition could be to have the tax lien cleaned up if it was that case of not paying the taxes. Are there any other questions regarding credit? I know it's kind of a bland subject, and with commercial lending, it can be, as you saw with the scenarios, it can be kind of a gray area because we can sometimes make exceptions depending on, you know, we have to look at the whole picture. And we do look at historical numbers as well. We always ask for a few years of tax returns for businesses that have been in business for 2 years or more. And when there isn't, if it's a startup, which we certainly look at those as well, we ask for 2 full years of projections with their business plan.
If anyone has any
thing
questions,
that I'm
please
often-
feel free.
Go ahead, Dan.
If
What was
anyone
that?
has any questions, please feel free. You can either type them in the chat. If you'd like to unmute yourself, feel free to do so, and we'll try to see if we can get everything answered today.
So my question is, as you can probably tell, I'm a SCORE mentor as well. And my big question is, what do I tell my clients? And my big takeaway from today is that it's probably well worth asking for terms from your vendors earlier rather than later, because not only does that help your cash flow a little bit, but it will also begin establishing your credit history as a business.
Exactly. Correct. Absolutely. That's great. As a SCORE mentor, you know, guiding them on that is great. And then advising them about the vendor, like you said, getting vendor suppliers established and using them, and then also using a good mix of credit, basically the lines of credit, the term loans, and the vendors.
So you mentioned new businesses aren't necessarily ruled out. What do you look for from a new business, a startup who really may not have even revenue yet? What would you look for beyond a personal loan guarantee?
So what we look for is, in that case, depending on hopefully it's not something that they've just picked and they think they want to try. We have to obviously vet that. But we like to see a business plan, a full business plan, 2 full years of projections with their assumptions as to where they got the projections and how they came to that decision, or came to those numbers. We would take 3 years of their personal tax returns, and you know, if they're buying equipment or if they're just getting a line of credit or whatever the case may be, we would look at the overall picture and we would take their projections into consideration, and it would be measured up against when the underwriters do their analysis, they measure it against industry standards as well, and compare it with the business plan and their projections. And we look at the whole picture, and that's how we base startups. We often use, I always advise people in startup situations, if they haven't met with a SCORE mentor or an SBDC counselor or business advisor, that they should do that first to get their business plan going. Speak with the experts who at SCORE can guide them on doing their business plan and kind of vetting it out, saying, why do you want to do this? What's your experience? And coming up with the projections.
Would you be more comfortable with asset-based lending versus line of credit for a startup?
Yeah. I mean, that definitely, but often in startup situations, they need the working capital. And we use all business assets as the collateral unless they have something else that they want to use as the collateral. If it's not an equipment purchase or a term loan to buy equipment, the lines of credit are used for anything needed for 12 months and under, something that they can pay back. We do look at having borrowers pay down the lines of credit for 30 calendar days each year to clear it to zero or as close to zero as they can, to show that they're using the line of credit properly.
Is there a minimum loan that you would consider for startup business? In other words, if somebody just wanted to borrow $10,000 to buy cleaning equipment to start a cleaning business, would that be something you consider, or is that too small?
No, we would consider that. $5,000 or $10,000, that's obviously $5,000 is probably about as low as we would go. But yes, $10,000 is certainly something we would absolutely look at. In that case, we would still, if it's a startup, we'd still need a business plan, believe it or not, even for $10,000. I often joke with people, I'm like, it's going to seem like you're giving your life away here. But once we have your information in the file, it won't be as painful next time. People generally understand. And even for $10,000, I'd send them to you, Whit.
To them, it's a lot of money. So
I know,
I think they
10,000,
understand.
absolutely. Especially if someone's just, they want to, cleaning's their passion and they want to do that. I always say no loan or no question is stupid. No question, everything is possible. There is a possibility if the numbers make sense.
We did have a question from Fred in the chat asking about if you have any advice regarding getting credit started so that his business can purchase a large property to start the business.
So that's a great question. So in that case, we would need a business plan and the projections, everything that I've mentioned earlier. In this case, if they're starting up and they're looking to buy the property, it's going to be a startup. So their business credit would start being built upon the time that if they were to get approved and have the loan. Also, I would advise them, if it's an operating company, not just an investment property, to definitely get some vendor suppliers, some lines opened out there if it's applicable to their business, so they can increase that PAYDEX score. Are there any other questions?
Thank you everyone for joining us. I will send out the slide deck and a recording of the workshop and a follow-up, and I will send out the emails of our presenters if they're okay with that. If you do have any further questions or you'd like to touch base, they will be able to get in touch with you. If that is okay with you, Jeanette?
Absolutely.
Perfect. All right. Thank you everyone today, and we'll give you some time in your day back. Thank you for joining us.
Thanks. Thank you all.
Thank you, everyone.
Yep. Bye-bye.